Welcome to another of our Pakistan 100 podcast series. My name is Hasanain, and I'm joined today by Dr. Adeel Tariq, who is an assistant professor of economics here at the LUMS economics department. Adeel is a PhD from Binghamton University, and one of his many interests lies in the financial sector of Pakistan. The financial sector, which is the provider of capital, is important because capital is one of the four major factors of production or components that go into economic activity. And one of the sort of critical aspects of a well-functioning capital market is the separation of control and use of capital from its ownership, which means that if I have some savings, that my returns from the saving aren't tied only to my use of the capital. It can also be that I've lent the money to someone who can use it more profitably than I can. We can separate sort of capital into both the formal and informal financial markets. But Adeel, why don't you start us off with giving us just a bit more on the importance of capital, and then we'll take it from there.
Sure. Thanks, Eddie. So, as you just mentioned, in any economy, so the role of the banking sector primarily is basically to mobilize savings and, for capital formulation, which is a key factor of production in an economy, in output. So what happens is that, if you look at developing countries, you find a lot of these economies are primarily banking-based systems as opposed to market-oriented or market-based systems, in which you have more developed financial products and securities markets and bond-based markets, which are basically functioning in that key role of providing capital to basically investors and helping spur economic growth. So in Pakistan, this has basically been the same since its inception, and since the financial sector basically just burst onto the scene in the 70s, when you had a rigid nationalized structure, but it was basically all banks, and it's the same today, even after so many decades of reforms and so many decades of change, privatization. It's still primarily a banking-based system, which hasn't really developed into a more complex financial market-based system.
So for the audience, just give us a little bit about what type of financial instruments or entities are there in more mature financial markets that are missing in our country?
Right. So just to put it very simply, what happens when these financial markets grow and evolve is you get all of these instruments which basically enable, again, to put it very bluntly and very simply, gambling on this whole system of finance and the banking system. So by that I mean that basically, if you have, let's suppose, loans such as mortgages, and the reason I mention that is again linked to the financial crisis of 2008, when basically mortgages were the basic instrument which propounded that whole financial global crisis. So if you have these basic instruments like loans, on houses and homes, you can basically increase the amount of debt exponentially, the amount of credit exponentially, which again enables capital formulation, which enables investors to basically grow the economy by placing bets on those instruments. So you can back those loans to basically go bad, or you can back them to basically just people to pay up on time. So that's just again just the basics of what a market-based system is, where you have all of these advanced instruments such as credit default swaps or collateralized debt obligations. You have futures, you have swaps, which is again just gambling on all of these basic banking instruments. And if those bets basically go bad, then you can have a scenario such as the global financial crisis.
So you call them bets, but isn't there a distinction, which is that a bet is a pure game of chance?
Right.
Whereas what you're calling a bet here is
Right.
really an investment that's based on a belief
Right.
that you have some sort of information or a tendency to get these calls right.
Right.
Isn't that right?
Yeah. That's right. I mean, if you look at any like gambling game, that is essentially true. That there you do basically have these informed beliefs about how an outcome is going to play out, and that's where you direct that information in making an informed sort of bet on the outcome. So it's similar for the financial markets, where you basically, the problem is that you're not basically, it's not based on anything real. The real asset on which, again using the example of mortgages, is homes, right? So if the value of homes collectively is, let's suppose, $1 million rupees, right, or $1 million. So when you incorporate all of these advanced instruments, which is just gambling on the outcomes of those these real assets, that can be translated into like a collective debt, a collective gamble of like billions of dollars. So
Okay.
that's basically.
I understand what you're saying, but let me try and refine this a little bit.
Yeah.
Because our audience might be a little literal.
Right.
And let me go back to one of the sort of fallback examples that investment classes take, which is that imagine that there is likely to be rain tomorrow.
Right.
Do I invest in a company that produces umbrellas today?
Right.
Now, if I have better weather predictions than others, what you're calling a bet, or my what you might call a gamble on, which is my decision to invest in the company,
Right.
might pay off better.
Right.
And so, in the extreme, if I have very good information, it's not really a bet; it is an investment.
Right.
Would you call it? Would you agree with that?
I do.
So now, the value of having lots of people who have some information about the future making these decisions is that the market is able to tap into the disparate information signals that everyone has and collectivize that in the price.
Right.
In the US, since I think the 2008 election onwards, there's been a large conversation about prediction of elections, the prediction markets.
Right.
Where everyone places what we're calling a bet, but it's not really a bet. It's more sort of an investment decision that's based on underlying information also. Whereas, in contrast, a gamble would be something that is a pure game of chance. So, the rolling of dice.
Right.
And this is slightly different from that.
Yeah, sure. So, yeah, so I'm glad you clarified that, because it's obviously not a pure game of chance where you're just rolling the dice and you're hoping for an outcome. It is an informed game of chance. The problem is that you had all of these financial institutions, these banks, these agencies, which were extremely exposed if the bets basically didn't pay off, and if they what they were gambling on, again in the sense I'm talking about, if the gamble didn't pay off, if things went bad, the whole economy is basically exposed. So I agree with what you're saying, but again, the thing I'm alluding to is not the percentage of chance that's involved in the game, but how exposed these systems are, these banking systems, the economy is.
Sure.
So, yeah.
Okay. So let's move now to. You said that we've had a banking sector that's had that problem since at least the 70s.
Right.
But we also know that there's been significant reform in the late 90s. Can you tell us a bit about that?
Sure. So if you just go back to just the late 1980s, just before these reforms kicked in. So you had this, really large nationalized structure in Pakistan for the banking sector. So you had, I think, 6 major national banks, state-owned banks, which controlled more like I think 90%, 93% of the market share. And they were overstaffed, they were overbranched. They had, like, the state-owned banks had over 7,000 branches at that time, which is again a huge number if you compare it to today. They were a lot of employees, and these sort of things are basically what in economics we call productive or technical inefficiency, where you basically are not using your resources in the most efficient manner to produce a service or an output or whatever.
So what was missing was that there was a restriction on new banks?
Yes, there was a restriction on new banks. There were taps on lending rates. There were non-performing loans, which is basically bad loans, which when you give out a loan to let's suppose any company, and they don't pay it back, it goes bad. So the State Bank of Pakistan classifies that as a non-performing loan. So again, these problems were more to do with the productive efficiency of things. Then you also had these corrupt practices which all of these banks were practicing, which was enabled by the State Bank itself because it wasn't really independent from the government. And you had all of these companies where you had these influential board owners and influential executives who were basically politically connected, and they could influence lending towards them. They could get all of these loans from the banks and then not pay them back. So there's this study by Atif Mia and Asim Khwaja which basically shows that comprehensively, and in the bank sector for Pakistan, this was a major problem where there was this problem of rent-seeking behavior by these politically connected firms, which was again enabled by the problem was that the State Bank, the Central Bank of Pakistan, was not autonomous. It wasn't independent. So that was like sort of the prelude to the banking reforms. And the second thing which I'm talking about, that when you obviously have these banks, the banking system being influenced by the government in a corrupt manner by these politicians, and you're directing credit towards their companies and their whatever they want the loans for. So it's basically crowding out small and medium enterprises. It's crowding out investment. It's crowding out loans through industry. It's crowding out consumer spending. So it basically that's basically inefficiency of a different sort. It's basically what we call allocative inefficiency in economics, which basically means you're not allocating the resources that you have to what the market, the economy is really demanding in terms of goods and services. So the IMF basically came in, and there were these reports which just lambasted this whole corrupt system, and they called for widespread reforms. And this word was the reason I talked about inefficiency, is because that word was used a lot, that this is a highly inefficient system, it's a highly corrupt system. You need reforms, you need major change, you need privatization, you need liberalization, you need basically massive change in the banking sector. And that basically started in the mid-90s. And the first major step was basically the State Bank, the Central Bank, was granted autonomy in 1997. So some people just say this is a sort of a hot political debate currently as well, whether it's really autonomous, right? But again, relative to how it was before the 90s, that's when it was even at a surface level there was no autonomy, right? So that was the impetus for reforms, right? That the State Bank basically had autonomy, then it had independence. And then they just started privatizing all of these big banks. They had these golden handshake schemes for the overstaffed banks, where I think around 22,000 employees were given these voluntary golden handshake schemes from these national banks. And then a lot of the branches were closed down. A lot of new banks were allowed to enter. There were these schemes which were set up to allow these new banks to come in. The non-performing loans was directly tackled by introducing new reforms. Before then, I think the non-performing loans in the sector were 22% of total loans, which basically means that out of like every 100 loans that the bank was giving out, 22% of them, 22 of them were bad loans, right? They were not being recovered, right? So which was obviously contributing to a lot of
and so
losses.
Is that the number of
loans, so not,
or is that the value of loans?
That's the value, that's the value, right,
okay.
right.
So of 100 rupees that are given
100
out,
rupees, sorry, yeah.
we only recover 78 rupees.
Yes,
and
yes.
We're not making a profit off of that.
Obviously, so that was basically, how these reforms basically kicked in.
So quick questions.
Yeah.
The first is, overall, was the reform of the late 90s successful?
Yeah, so this is something I've personally, worked on. I've done research on this. So because what motivated me was that there wasn't, much consensus on this, right? A lot of early studies suggested that, yes, these reforms were successful in raising especially efficiency and performance of the banking sector, but then other studies found that there weren't any significant effects of these reforms. So I basically did the study by using the state of the art economic methods and models. And what I found was that basically what happened was, when you have these sort of really widespread, really dramatic reforms, which sort of rebirth the whole economy. So you get birthing pains. So what happened was that in the implementation phases of these reforms, so it happened in like 3 phases. There was like the first phase was in the early 90s, 93 to 95, then 97 to 98, and then the third phase was 2002 to 2003, right? And so what I found was that during the implementation phases, when the reforms were enacted, you saw a dip in performance, you saw a dip in efficiency. Again, so you could, classify this as birthing pains, as, the banks adapting, adjusting to the new system. But after that, you found, significant upward ticks in all of these indicators. So they were definitely successful. It was just, that, things were so bad that it took time for the sector
whenever
to
you
recover.
have your policy, it takes time to adjust to that. Organizations have to reorganize themselves.
Right.
People have to move.
There's a learning curve.
There's
Exactly.
a learning curve for sure. But so go back to the classic Khwaja and Mia study.
Right.
Am I correct in recalling that the non-performing loans that they had looked at, and again, I think the data was from the 90s again?
Yeah, it was from the 90s.
The distinction they found was that it was public sector banks that were giving out the non-performing loans to politically connected people.
That's right.
But the private banks were not doing that.
They were not doing that. Right.
Because so if I have a private company, the fact that a politically connected person is coming to me for a loan can create pressure, but it is but I also have a profit pressure on me.
Right.
Whereas if I'm a bureaucrat or if I'm a banker in a public sector company, where my job does not sort of succeed or fail on the basis of profits. The way to navigate a complex that political situation is for me to try and garner favor with the politician. Is that right?
Absolutely.
All right. Now, sort of move us forward then to the 2007 financial crisis and how that impacted Pakistan.
Right. So what happened in the 2007 financial crisis, which just initiated in the US, is that you had, so again, to put it very simply, you had a lot of bad loans. You just basically had these mortgages, which are basically home loans, housing loans, which were given to people who had poor credit, who you basically so there was no verification, there was no checks, so they were just giving out loans to everybody. The fallacy over here was that everybody involved in that system believed that nobody will ever default on their mortgages, right? Because if they do, they have no incentive to do that. They'll basically lose their homes. But it was that's why you call it a housing bubble. That's why that term was used, because when you're continually giving out loans, to people who can't afford those homes, right? You're giving them loans, you're giving them, these mortgages. They're eventually going to, go bad. They won't be able to pay up, and that's where what we talked about in the beginning of the more market-based, advanced, financial instruments. That's where that role comes into play. You had this,
So tell us how it impacted Pakistan.
So basically, in the US and in the developed world, because you had all of these, these developed and advanced complicated financial products, which, enabled, for example, a mortgage, collective loan of, let's suppose, 1 million to be translated into billions of dollars. In Pakistan, we didn't have those, advanced instruments. So that's why we were, basically, we weren't exposed. The Pakistani banking sector wasn't exposed. That's one reason. Another reason was we weren't really integrated into the, the global international financial market. And again, that's connected to the first thing that, we didn't really have these advanced instruments, these advanced financial products. We basically, just had a very basic banking, system.
So what I'm hearing is that these instruments are a double-edged sword. We had the financial crisis of East Asia in the 90s.
Exactly, yeah.
Which where,
the Asian financial crisis,
where the countries that did best out of that were the ones that created those clampdowns on the financial market.
Right, absolutely.
The fact that Pakistan and other countries that weren't exposed as much or weren't integrated enough in the financial market might have been bad for the boom years before.
Exactly,
but also saved us in the 2007 financial crisis. That's not to say that we shouldn't be integrated.
Absolutely.
Because the upside is probably larger.
Yeah.
But there's that side of the sword, right?
Absolutely.
Was there anything specific in terms of reforms that we undertook because of the 2007 crisis?
Yeah. So I just want to add something before that. So this was one of the reasons why we weren't exposed. Another reason is, this is something I've looked at again in my research, is that before the, this financial crisis, the Pakistani banking sector underwent a lot of governance and structural changes. You had a lot of these mergers and acquisitions. You had, these large national banks which were privatized. And I basically looked at the effects, the causal effects of these things, of like structural changes, governance changes, M&A activity, these governance changes on the stability and risk-taking behavior of banks. And what I found was that conclusively and significantly, M&A activity, these other things I talked about, which happened in the Pakistani banking sector, they were associated with lower risk-taking behavior and higher stability. So all of this happened in the prelude to the financial crisis. So that was another reason why we weren't really that exposed to the financial crisis, because before that thing hit, in the US and in these developed countries, you had guys like Alan Greenspan who were, very pro, free market. Mm-hmm. There was, they were advocating against regulation. So you had these, basically financial systems which were basically unchecked. And in Pakistan, you had all of these regulations and, all of these things, which were basically helping us, basically be covered from, these bad loans and all of these things. So obviously in the wake of this global crisis, one of the things that came out was that obviously you need more regulation, right? Obviously, free markets are important, but you can't, leave these hugely vast, complicated financial systems completely unchecked. You do need regulation. You do need checks in the sense that the banks need to be covered. They shouldn't be so exposed that if this sort of black swan event happens, that a 1 in a million chance of all of these loans going bad. Which in retrospect wasn't really, a 1 in a million chance. It was, building up. It's nobody, just saw that at that time. But if something like that happens, you should hedge your bet. You should be covered, right? So you had increased capitalization requirements. You had increased liquidity requirements, right? So there was something known as the Basel III Accords, right? Which was implemented worldwide, including in Pakistan. And what we saw was that, in the wake of those reforms, the post-crisis reforms, performance in Pakistan again dipped, right? So it did go down again because, you have higher capitalization requirements, you have more liquidity, constraints, you had, further, you had to take more provisions against non-performing loans, right? Again, that's a way to hedge your bets. So if you have more provisions against non-performing loans, you can obviously, you're basically covered in some sense. So those things happened in Pakistan, and that again led to a dip in the performance and efficiency of banks, which was a cause for concern. But again, it was inevitable, and it was probably a good thing.
And it was intended to lower risk in the market.
Lower risk further, right?
So look, we're running out of time,
Yeah.
and there are a couple of things that I wanted to ask you about. One is sort of Pakistan's experience with Islamic banking.
Right.
The other is how the government has been taking loans from the banking sector to meet its own financing needs,
Right.
And thereby creating a lack of appetite of the banks to go for higher risk
Right.
loans to the citizenry,
Right.
which would actually be better for the economy.
Yeah.
But because banks are already getting very safe demand for loans from the government, they're not lending to the private sector. But because we're short on time, I'm going to skip forward to one last question, which is what is the health of our financial sector today, and where do we go from here?
Right. So we've come a long way. We've taken a lot of positive steps since those pre-reform days. The sector as a whole is more efficient. It's more competitive. The main challenge now is the one thing you mentioned is obviously you need to integrate into the financial global market. You do need that. You do need more of these advanced financial products. You need these financial markets which help you grow. The downside is that if you're too exposed, then things can go really, really bad and really south very quickly. But we do have things mostly covered on that end now, that we are really well capitalized. The banking sector is well capitalized. It's the liquidity constraints are really good. So we do need to take that step because it's inhibiting our growth as in the financial sector and the economy as a whole. The other thing is the state bank has this like the mantra of financial inclusion and access to finance for women, right, which is a big problem in Pakistan. So basically the ratio for bank deposits to GDP in Pakistan is just 16%, which means that out of the total value of GDP, only 16% are bank deposits, which is like 3 to 4 times lower than what it is in the rest of the region, right? The other thing is that women bank accounts are just constitute 11% of total bank accounts. Only 13% of borrowers are women. 5% of total loans come from women, and for small and medium enterprises, the people who borrow for that sector, only 2% are women, right? So this is something which is, again, a lot of research now shows that you need women participation in your in the labor force, in the economy, to help spur economic growth. So in Pakistan this is a big problem, right? And the financial sector has a key role to play in that. So we do need even though the state bank has been calling for this and advocating this for the last 5-6 years, we haven't really made much strides. There has been some things which we've done. Microfinance banks like Jazz Cash, Easy Paisa, these things help access to finance for women, and these things help in increasing financial inclusion, because people don't have to, women and people who can't go to branches to actual brick and mortar branches, they can use their mobile phones, they can use their apps to basically conduct these different exchanges. You need branchless banking, right? That's very important. Again, the role of IT is very important in this. Again, you have these microfinance instruments like Jazz Cash, Easy Paisa, as I mentioned, who is a big pivotal player in just furthering this goal of giving access to finance to women. But these things really need to be accelerated, because if you look at the experience that Bangladesh has faced, if you look at India's experience, Nepal's experience, so they are way ahead of us, right? And we've been just beating around the bush for a long time, and we're not really we're not progressing much, even though you have these flashy indicators that you have so you're doing a lot for access to finance for women. But if you look at the actual numbers, the research, it's really slow, and it really needs to be. So that's probably the main challenge for the main goal that we should have for the future.
All right. Well, Adeel, that's about all the time we have. This has been very informative. It's raised more questions than answers in my mind, but the first step to understanding anything is to raise the right questions. So I really appreciate your coming on. Thank you.
Thank you so much.